If you're holding Bitcoin right now and you are scared, here is the uncomfortable fact you need to hear. The exact data point causing that fear is, according to the same on-chain research firms tracking it, one of the more reliable signals that has historically preceded a market bottom, not confirmed a market collapse. Long-term holders selling at a loss sounds, on the surface, like the worst possible sign a market can produce. If the people who have held the longest, through the most volatility, are finally giving up, what hope does anyone else have? That is the version of this story spreading across social media right now, and it is missing the second half of the data entirely. This video walks through 4 specific verifiable data points: the true scale of long-term holder capitulation, the timing of that capitulation relative to where the market sits today, what institutional ETF flows actually did in the most recent trading days, and a specific on-chain ratio that has, without exception, compressed at every major bottom in Bitcoin's history before a real recovery began. None of this is a price prediction. All of it is information you can verify yourself from the same sources this video is built on. Here's where the market actually sits as this video is being recorded. Bitcoin is trading around $62,800, down roughly 1.5% over the past 24 hours, with a range between roughly $62,600 and just under $64,000. According to Glassnode's on-chain research, Bitcoin has now spent approximately 5 months trading below its true market mean, a cost basis metric sitting between roughly $76,600 and $79,000. It has also spent that stretch below the short-term holder cost basis, currently near $72,000, marking one of the longest sustained periods of what Glassnode calls deep value trading in Bitcoin's entire history. Notice that number carefully because it matters for what comes later in this video. 5 months, not 7. The phrase circulating widely right now among frustrated holders describes this as a 7-month-long dip, and that specific exaggeration is worth pausing on before we go any further, because it tells you something important about how fear distorts a timeline even before it distorts a decision. The realized profit and loss ratio, a metric tracking whether coins moving on-chain are being sold at a gain or a loss, has been sitting below 1 for an extended stretch, meaning losses have been outpacing profits on a realized basis. Historically, according to Glassnode, periods like this have typically lasted over 6 months before meaningful recovery signals emerged, which places the current stretch close to, but not yet past, the historical pattern for how long this specific kind of pain has lasted before conditions started to turn. There's also a specific price level worth naming, because it keeps reappearing across multiple independent reports covering this same period: $69,000. That figure was Bitcoin's all-time high back in November of 2021, right before the market cratered into the previous bear cycle, and it has become the current focal point for price action during this stretch of the drawdown, sitting just above the short-term holder cost basis discussed a moment ago. Options market positioning adds one more layer of texture to this picture. The put-to-call ratio recently fell to 0.56, its lowest reading of the year, indicating an uptick in demand for call options relative to puts, even as perpetual futures funding rates have remained relatively subdued rather than heavily skewed toward aggressive bullish leverage. That combination, more demand for upside protection without excessive leverage long positioning, describes a market that is cautiously repositioning rather than one caught in either blind panic or reckless greed. Okay guys, before we move on, I need your help on this. As you've noticed, we changed the video format. We moved from the avatar-only format to this whiteboard style, and honestly, this new format takes far more time and far more work than what we used to produce. Every illustration you're seeing is hand-built block by block, and that is simply not sustainable if it's not actually working for you. So here's what I need. Drop a comment right now with your city, the time it is for you as you're watching this, and what the weather looks like where you are. That's it. 3 things. If this comment shows up, it tells me you're actually engaged with this new format, not just letting the video play in the background. And that's the exact signal I need before deciding whether to keep producing videos like this one going forward. Don't forget to hit that like button and subscribe. This really helps us. This channel runs on direct feedback now, not on an algorithm deciding what's worth making. So if the whiteboard style is landing for you, this is the moment to prove it. City, time, weather, right below. Let's get into it. None of the historical patterns referenced in this video guarantee that this specific cycle behaves the same way previous cycles did. A market that has been in deep value territory for 5 months can remain there for considerably longer. And Glassnode's own reporting has repeatedly noted that traders should not rule out further downside while the market remains below both the true market mean and the short-term holder cost basis. Before reacting to any headline about long-term holders selling at a loss, it is worth being precise about what that phrase actually describes, because the term gets used loosely and the precision matters. A long-term holder in on-chain analysis is any wallet holding coins that have not moved in more than 155 days. Capitulation, in this specific context, does not mean panic. It means that cohort of long-held coins is being sold at a realized loss relative to the price at which those coins last moved. This definition matters because the word capitulation carries emotional weight in everyday language that the on-chain metric itself does not actually measure. The metric is purely mechanical. It tracks the dollar value of coins moving on-chain, held longer than 155 days, sold at a price below their last recorded cost basis. Whether the person behind that wallet felt calm, desperate, or indifferent while making that trade is not something the blockchain records at all, only the transaction itself is. According to Glassnode's most recent week on-chain reporting, the share of total realized value attributable to long-term holder losses climbed from 15% in early February to 43% by July of this year. Entity-adjusted realized losses from this cohort peaked at approximately $280 million per day, a level not seen since December of 2022, which was itself deep inside the previous bear market, following the collapse of a major exchange that year. This is precisely the kind of number that sounds unambiguously terrible in isolation, and it is exactly why context matters more than any single statistic pulled out of a report. Glassnode's own analysts noted that this pattern of long-term holder loss realization is tracing a reversal structure remarkably similar to patterns that preceded recoveries during the 2018, 2020, and 2022 bear market lows. The mechanism behind why this happens is not mysterious once you walk through it. Long-term holders are, by definition, the participants with the longest time horizon and the highest average cost basis tolerance in the entire market. When even that specific cohort begins capitulating in large numbers, it typically means the pool of remaining sellers still willing to exit at current prices is shrinking rapidly, since the most patient capital in the market is the last capital left standing before a genuine bottom forms. Put another way, long-term holder capitulation has historically functioned less like a signal that the market is broken, and more like a signal that the market is running out of people left to disappoint. Every seller who exhausts their own patience and sells removes themselves from the pool of future potential sellers, which is precisely why analysts watch this specific metric as a proxy for how close a market is to having sold through its available supply of frustrated holders. It also helps to understand why long-term holders, specifically, are the cohort worth watching rather than short-term holders, who sell at a loss constantly throughout any market cycle without it carrying the same signal. Short-term holders, by definition, bought recently, meaning their cost basis sits close to whatever price the market happens to be at. So ordinary volatility routinely pushes some portion of that cohort into a temporary loss without meaning much of anything. Long-term holders, by contrast, generally sit on a substantial embedded gain from an earlier, lower entry, which is exactly why it takes a genuinely severe, sustained drawdown to push a meaningful share of that specific cohort into realized loss territory at all. None of this means every individual long-term holder currently selling is making a mistake for their own personal situation. Some may have genuine personal reasons entirely unrelated to Bitcoin's thesis, a need for cash, a change in financial circumstances, or a decision that has nothing to do with conviction in the asset itself. The point of this section is not to judge any individual seller. It is to explain what the aggregate behavior of this specific cohort has historically indicated about where a market sits in its cycle. Historical pattern repeating is not a law of physics, and long-term holder capitulation reaching a high level does not by itself guarantee that a bottom is in place. It is entirely possible for this specific metric to peak, decline, and then rise again to a new high if the underlying conditions driving the sell-off have not actually resolved. Treating a single on-chain metric as a reliable timing tool on its own is itself a version of the same mistake this channel has spent multiple videos warning against, replacing one slogan with a slightly more sophisticated slogan without actually checking the full picture. Here's the detail that changes the entire framing of everything covered in the previous section. And it is the detail almost entirely absent from the panic currently circulating. According to Glassnode's week on-chain report published on July 16th of this year, long-term holder capitulation, described in that same report as the dominant source of selling pressure throughout 2026, has begun to decline from its cycle peak. This is not a subtle distinction. The $280 million per day figure covered in the previous section was the peak, not the current reading. The wave of selling that produced the fear currently spreading across social media already crested and has started rolling back, according to the same research firm whose earlier numbers are being used to justify that fear in the first place. A separate report covering the same period noted that Bitcoin briefly surged above $65,000 after a softer than expected inflation print, before slipping back as long-term holders continued cutting losses and short-term holders took profits into the bounce. Glassnode's own framing of this specific dynamic described long-term holder realized losses as having peaked roughly 2 weeks prior to that report and continuing to decline since. This is precisely why the timeline exaggeration flagged earlier in this video matters so much. A holder who believes this has been a 7-month-long dip when the actual figure is closer to 5 months is not just off on a technicality. That same holder is very likely also unaware that the specific metric driving their fear, long-term holder capitulation, has already turned a corner according to the data. Fear compounds timeline errors, and timeline errors compound fear, in a loop that has nothing to do with what the on-chain data actually shows. There is a specific practical reason this distinction matters for how a holder responds emotionally to a red day in the market. Selling into a metric that is still accelerating toward its worst reading is a very different decision than selling into a metric that has already peaked and is actively declining, even if the price action on any single day looks identical on a chart. The first scenario describes genuine ongoing deterioration. The second describes the tail end of a stress event that has already done most of its damage. There's also a supply-side implication worth drawing out explicitly. Bitcoin briefly recovered from a low near $58,300 to $64,400 over the course of a single week, then pulled back towards $62,700, a round trip that still left price below both the true market mean and the short-term holder cost basis discussed earlier in this video. Glassnode's own framing of that bounce noted that a genuine transition toward bull market conditions requires this specific capitulation figure to compress meaningfully further alongside stronger ETF demand, rather than the current partial cooling being sufficient on its own. A metric turning down from its peak is not the same as a metric returning to a healthy baseline, and long-term holder capitulation remains, by Glassnode's own description, elevated relative to typical market conditions even after cooling from its cycle high. A single data point rolling over for 2 weeks is a meaningfully smaller sample than a full multi-month trend, and it remains entirely possible for this specific figure to spike again if a fresh negative catalyst hits the market before the current cooling trend fully plays out. If distinguishing between a metric that is peaking versus a metric that is cooling feels like exactly the kind of detail you wish you had checked before making your last decision under pressure, that is precisely the skill the Bitcoin Holder's Bible is built to give you. It walks through the specific on-chain thresholds covered in this video, including long-term holder realized loss, the true market mean, and the short-term holder cost basis, translated into a simple weekly check so you are reading the same data analysts read on your own schedule before panic gets the chance to read it for you. Normally, this ebook is $97, but the code DIAMOND50 at checkout brings it down to $47, with the same full money-back guarantee I've mentioned before. If it doesn't leave you with a clearer way to check these numbers yourself, you get every dollar back, no questions asked. And remember, this channel doesn't run on ad revenue anymore, so every person who picks this up is helping keep videos like this one being made. The link is in the description and pinned in the comments. I see the diamond. Let's get into what institutional money actually did over the past few trading days. While long-term holders were realizing losses at the pace covered earlier in this video, US spot Bitcoin ETFs were going through their own version of the same stress test. And that story has also just changed direction in a way most of the current panic has not caught up with yet. According to Farside Investors, which tracks daily primary market flows across the full US spot Bitcoin ETF complex, these products had just come off an 8-week outflow streak that drained more than $8 billion from the category. That is a genuinely severe, sustained withdrawal of institutional capital, and it is the honest starting point for understanding why sentiment around ETF demand soured as badly as it did over the past 2 months. On July 16th, that streak broke. US spot Bitcoin ETFs recorded $79,150,000 in net inflows, marking a third consecutive day of positive flows. BlackRock's IBIT led the category, absorbing approximately 75% of that total, or $33,440,000, while Fidelity's FBTCs added $30,700,000, and Bitwise's BITB contributed $15 million. The composition of that flow matters as much as the total. A separate report on the same data noted that the mix was healthier than some earlier sessions, specifically because inflows were spread across 3 major issuers, rather than being almost entirely dependent on BlackRock, since concentrated demand from a single issuer has historically proven less durable than demand spread across multiple products. On July 15th, IBIT alone had accounted for roughly 75% of that day's total inflows. A day later, Fidelity and Bitwise together contributed more than half of the day's total Bitcoin ETF inflow. It is also worth noting what did not happen during this specific window. Grayscale's older Bitcoin trust, which has historically produced outflows large enough to offset gains elsewhere in the category, stayed flat on July 16th. When that specific source of redemption pressure goes quiet, new money flowing into IBIT, FBTC, and BITB translates directly into a positive result for the category as a whole, rather than being partially absorbed by an older product's ongoing redemptions. This 3-day sequence followed an earlier stretch in early July, where Bitcoin ETF inflows totaled $510 million across 3 consecutive sessions, ending a 10-day, $2,730 million outflow streak. Taken together, these 2 separate reversal episodes within the same month describe an institutional flow picture that has been considerably more volatile and considerably more prone to snapping back than the smooth, one-directional outflow narrative currently circulating among retail holders. The broader macro backdrop is also worth naming, since ETF flows do not move in isolation from the rest of the financial system. A softer than expected U.S. inflation print, showing annual consumer price growth of 3.5% and a below consensus producer price reading, helped trim market expectations for a July interest rate increase down to roughly 10%, improving risk sentiment across financial markets more broadly, not just within Bitcoin specifically. That kind of macro tailwind tends to matter most at the margin, during exactly the fragile early stage reversal windows this section has been describing. It is also worth understanding the actual mechanism connecting an ETF share purchase to real Bitcoin leaving the open market, since this is not simply a paper transaction. When new money flows into a fund like IBIT or FBTC, an authorized participant, a large broker-dealer registered with the SEC buys real Bitcoin on the spot market and delivers it to the fund's custodian in exchange for newly created shares. That means every dollar of net inflow reported in this section corresponds to real coins being pulled off exchanges and into custody, not simply a number moving between financial accounts. 3 days of inflows following 8 weeks of outflows is a reversal in direction, not proof of a durable new trend, and this exact market has already produced at least one earlier false start this same month, when a $510 million 3-day inflow streak in early July was followed by renewed weakness before the most recent recovery began. A single concentrated issuer, like BlackRock's IBIT driving the majority of any single day's flow, also means the category remains more fragile to a reversal from one large participant than a genuinely broad-based institutional bid would be. There is a 4th data point worth covering in this video precisely because it almost never makes it into the panic-driven version of this story, and it comes from a completely different angle than either long-term holder losses or ETF flows, the RODL ratio, a metric developed to compare the wealth held by long-term holders against the wealth held by newer market participants. According to Glassnode's tracking, the RHODL ratio reached 6.5 in early July of this year, its second highest reading in Bitcoin's entire history. A high reading on this ratio indicates that long-term holder wealth remains unusually elevated relative to newer entrants, which sounds, at first glance, like a sign of excess rather than opportunity. The more useful way to read this ratio is through what happens as it compresses, meaning as newer buyers begin accumulating a larger relative share of wealth compared with long-term holders. Bitcoin continues trading near $60,000, while coins change hands without visible signs of panic, a pattern consistent with the gradual transfer of supply from long-term holders, many of whom accumulated throughout 2023 and 2024, toward a new cohort of buyers who view current prices as a discount rather than a warning. This dynamic is sometimes described through the lens of the Wyckoff model, a century-old framework from technical analysis describing how markets move through distinct phases: accumulation, markup, distribution, and markdown. Under that lens, the current activity resembles the earlier stages of a redistribution process, where more experienced holders gradually transfer supply to a new generation of buyers before the next phase of the cycle begins, rather than a chaotic, disorderly collapse. The historical precedent for this specific ratio is worth stating plainly because it directly addresses the same question every other section of this video has been circling. Extended consolidations near the 2015, 2019, and 2023 lows each preceded meaningful recoveries, and in every one of those cases, the RODL ratio compressed before the price eventually broke higher. This is now the second highest reading of that ratio ever recorded, occurring during a period that, by multiple other metrics covered in this video, already resembles the late stages of a capitulation event rather than its beginning. It is worth being specific about what makes this ratio genuinely different from simply watching price or watching a single cost basis level. The RHODL ratio is constructed from the realized capitalization of coins, weighted by how long they have been held, which means it captures something neither price nor a single cost basis can, the actual distribution of wealth across different holding periods, all at once, updated continuously as coins move on-chain. A holder base that is aging, meaning wealth is concentrating in longer held coins, tends to show up in this ratio well before it becomes obvious in price action alone. A ratio reaching its second highest level in history is also, by definition, an unprecedented reading with limited historical comparison points, and unprecedented readings carry a genuine risk of behaving differently than any prior instance simply because the market itself, its participants, and its structure have changed meaningfully since 2015 and 2019. The presence of spot ETFs, corporate treasuries, and a much larger base of institutional participants means this cycle's version of long-term holder behavior may not compress and resolve on the same timeline or through the same mechanism, as it did in smaller, more retail-dominated markets. None of the 4 data points covered in this video are difficult to check yourself, and that is precisely the point of walking through them in this much detail rather than simply asserting a conclusion and moving on. A real framework replaces a feeling of panic with a short, specific list of numbers checked on a recurring basis, rather than reacting to whatever headline or thread happens to be circulating on any given day. The first number worth checking is long-term holder realized loss as a share of total realized value, along with its daily dollar figure, both of which are published regularly by on-chain research firms like Glassnode. Checking whether this figure is rising toward a new high or declining from a recent peak tells you which side of the capitulation event you're actually standing on, a distinction this entire video has been built around. The second number is the true market mean and the short-term holder cost basis, the 2 cost basis levels this video referenced when describing deep value territory. Tracking how long price is spent below these levels, using the actual figure rather than whatever rounded, exaggerated version is circulating on social media, keeps your own sense of the timeline anchored to reality instead of to fear. The third number is daily spot ETF net flow data, publicly available from Farside Investors and several other trackers, checked not as a single day's headline but as a short rolling trend. Is the category coming off an extended outflow streak? And if so, how many consecutive days of reversal have actually occurred? And how concentrated or broad is that reversal across the different issuers? The fourth number is the RODL ratio itself, along with an honest acknowledgement of its own limitation. An unprecedented reading, with only a handful of historical comparison points, being used to draw a conclusion about an unprecedented market structure. Checking where this ratio currently sits, and whether it is compressing or expanding, adds a fourth independent lens to the same question the other 3 numbers are already addressing from different angles. The habit worth building from all 4 of these checks is not memorizing today's specific figures, since every one of them will look different by the time you're watching this. It is building the muscle of checking the actual current number before reacting to a feeling, the same muscle every other video on this channel has been built to strengthen one specific, verifiable data point at a time. There's a simple discipline worth adding on top of all 4 checks. Writing down, in a single sentence, what each number would need to show for you to change your mind about your own position, before you check it, not after. A holder who decides in advance what a rising long-term holder capitulation figure, a renewed ETF outflow streak, or a sudden RODL ratio reversal would actually mean, for their own plan, is making that decision with a clear head. A holder who only decides what a number means after seeing it in the moment, with a red candle already on the screen, is far more likely to let the emotion of that moment write the conclusion instead. This is exactly why the Bitcoin Holder's Bible exists. It walks through all 4 data points covered in this video in far more detail, the specific on-chain thresholds for long-term holder capitulation, cost basis levels, ETF flow trends, and the RODL ratio, and a simple weekly checklist that lets you verify where the market actually stands instead of relying on whatever headline or thread happens to be circulating that day. The regular price is $97, and code Diamond50 brings it down to $47. And just like I've told you before, that comes with a full money-back guarantee. If it doesn't leave you with a clearer, more current picture of where this market actually stands, I refund you, no questions asked. Remember, this channel doesn't run on ad revenue anymore. Every person who picks this up isn't just buying a book, they're one of the people actually keeping this channel able to keep making videos like this one. I see the diamond, and the link is in the description and pinned in the comments below. Long-term holder capitulation reached a genuinely severe level, with realized losses climbing from 15% to 43% of total realized value and peaking near $280 million a day, a level not seen since December of 2022. But the most recent reporting shows that specific figure has already turned down from its cycle peak, meaning the wave of pain currently driving social media sentiment already crested rather than being an ongoing, accelerating collapse. US spot. Bitcoin ETFs went from an 8-week, $8 billion outflow streak to 3 consecutive days of net inflows, with the most recent day showing a healthier, more broadly distributed mix across BlackRock, Fidelity, and Bitwise, rather than dependence on a single issuer. The RODL ratio, meanwhile, sits at its second highest reading in Bitcoin's history, a pattern that has, in every prior instance, preceded a meaningful recovery rather than a further collapse. None of these 4 data points, taken individually or together, guarantees any specific price outcome from here. What they do prove is that the specific fear driving retail sentiment right now, that long-term holders capitulating means the bottom is nowhere in sight, is missing the half of the story showing that same metric already rolling over, alongside 3 other independent signals pointing in a similarly constructive direction. It is also worth restating the timeline correction from earlier in this video, since it is easy to lose track of amid 4 separate data sections. 5 months in deep value territory, not 7. That single verifiable correction is a useful test for how much of the current panic is built on the real data versus how much of it is built on an exaggerated version of that data that simply feels more dramatic to repeat. Nothing in this video should be read as a promise that this drawdown ends soon, or that any of the 4 metrics covered here cannot reverse back toward their more painful readings. Long-term holder capitulation remains elevated even after cooling from its peak. 3 days of ETF inflows is a small sample against 8 weeks of outflows, and an unprecedented RODL ratio reading is, by definition, being interpreted against a limited set of historical comparisons, in a market structure that has changed considerably since those comparisons were set. What this video does claim, honestly, is narrower and more useful than a prediction. The specific version of the panic currently circulating, built on an exaggerated timeline and half of the available data, does not match what the full current dataset actually shows. That gap between perception and verified data is the entire subject of this video, not a forecast about what happens next. If you hold Bitcoin and you're scared right now, the specific fear driving that feeling, long-term holders capitulating during what feels like an endless drawdown, is real, verifiable, and also incomplete. The same data source producing that fear also shows the capitulation cresting, ETF flows reversing, and a historically rare accumulation signal forming underneath the price action most people are reacting to. None of that means the pain is over, and none of it should be read as permission to stop checking the data going forward. It means the version of this story spreading fastest right now is not the same as the version the full data actually supports, and the gap between those 2 versions is exactly where a holder who checks the numbers ends up with a clearer picture than a holder reacting only to how the last red candle felt. That gap between the fastest spreading version of a story and the fully verified version of the same story is not unique to this specific week or this specific drawdown. It is the same gap this channel has pointed to across every video built on real, checkable data, and it will keep reappearing at every future turning point this market produces, whether that next turn is up or down. Drop a comment below telling me whether you had already seen the long-term holder capitulation number turning down, or whether this is the first time you're hearing that the peak already passed. The most thoughtful comments get pinned because the goal of this channel has always been clarity, not fear. If this video changed how you're reading the current drawdown, share it with the one holder you know who is currently panicking off half the picture. Every cycle produces the same split among holders, and it has nothing to do with who held the longest or who has the strongest opinions online. One group reacts to how the last week felt, repeats whatever timeline and whatever numbers circulating fastest, and makes decisions from inside that feeling. The other group pulls the actual current numbers, checks which direction each one is actually moving, and makes decisions from there instead. Nothing in this video tells you what to do with your own position, and nothing in it should. What it tells you is that the 4 numbers actually driving this market right now say something meaningfully more nuanced than the panic currently spreading about them, and checking that gap yourself, rather than inheriting someone else's fear, is the entire habit this channel exists to build. See you in the next one.